would I say, money that we have earned or that we've acquired through time that is used to pay for these assets, okay? But also at the same time, we may have bank loans, right? These bank loans also pay for the assets on the left-hand side, right? So your net worth really, which is the equivalent of a share equity account in business speak, will be the assets minus the liabilities plus the accumulated income, right? So your assets is your house, for example, minus the liability is your mortgage, right? So what's left is the value, the equity of the house, right? Plus all your savings that you have not spent is in that pot of net worth, okay? So that's very similar to the concept of share equity in a company, okay? Now I'm going to, in the foregoing slides, I will then explain to you in more detail on the share equity account and how that affects the valuation of shares, okay? Now, in the share capital account, here I say public companies will issue shares to shareholders. This will come into the share capital account. And if a company earns profits in its lifetime, this will also be recorded. So you can see the red lines here on the table, right? Share capital. So share capital is what you have contributed, or all shareholders, including insiders, including all the key shareholders, have contributed to the company. It goes under the share capital account, right? And accumulated profits also go inside. Forget about the other items, they're quite small. Okay, so this is very important. Now, these are all total sum, the total sum, right? But as public shareholders, you know that it's all fractionalized, right? We only own one fraction of a company, right? So this share capital account, the total equity here, we can see, you can actually say equity per share equals to the total equity divided by the total shares that are issued. Okay, so that will be relevant to you on a per share basis. Do I make it clear? That will be relevant to you on a per share basis. All right. Okay, so how will the share capital account move? This is quite important, right? Now, when a business is going on as a going concern, it is running as a going concern, it is operational, right? It will need money, right? It will have to pay staff, it has to pay, your suppliers, it has to pay for its renovation costs in the case of a restaurant, so on and so forth, as pay for its plant and machinery. So it needs actual money, right? It needs capital, right? So the capital can come from what? Initial shareholders that contribute, but also at the same time, the profits that are generated on an ongoing basis, right? After you pay dividends, there is leftover money. This money can be used to fund the operations of a company, right? So often in a growth company, companies that are growing very fast, they need to expand very fast and they need to invest a lot, right? So the initial capital and the profits that they have accumulated may not be enough, right? So they may put their hand out and ask public shareholders and say, hello, I need to grow. Can you give me some money? Okay, that's when the share capital account moves. So let me summarize. The share capital account moves when you raise capital from the market, whether it as an initial IPO, future raisings, and also in terms of the profits of the company that are accumulated after paying dividends. Okay, can you remember that? Your accumulated profits of the company after paying dividends and the equity that is contributed by your shareholders. So this is how the share capital account moves. Okay, so that's quite important because a lot of corporate action relates to this account, the share capital account. Okay, now I think I mentioned it before. I wanted to reinforce again through a table. Here you can see when you read your accounts, you can see that there are many shares, right? Here in this case, in the group, right, you have in 2024, 370 million shares, right? 370 million shares, okay? So the total number of shares in the company is 370. So this share in the company, you own one fraction of, sorry, you may own a few shares, right? But for what, for purposes of calculation, you share basis, okay, on a per share basis. So here you can see, right, net asset value per ordinary share, right, at the bottom line is 44 cents. 44 cents, right? How do you calculate net asset value per ordinary share? It is the total share capital of the account divided by the total number of shares, 370 million shares, to get 44 cents. Okay? That's all you need to know, right? So, okay, so now we want to cover all the different corporate actions. The first one we want to cover, which is the most common and happens almost annually, semi-annually, with a lot of companies, right? Which is dividends, right? I think most of you, I'm going to go through dividends quite fast because it is quite easy to understand. But essentially, dividends is the profits that a company makes that is paid to you as a shareholder. So every year, the company may, if a company is a profit-making company, it will have it may pay you dividends. It may or may not, right? But a lot of Singapore companies, in fact, pay dividends, right? What is dividends? Dividends is just a share of the profit of the company that's paid to a public shareholder. Okay, so that's dividends. And now, why do you deserve dividends as a shareholder? You own the company, so you have the right to receive profits from the company, right? And in a perfect world, if the management is working entirely for shareholders, in a perfect world, right, anything that they don't need to be retained because they don't need to invest anymore, everything is generated from the profits of the company, right? They can actually pay all the profits to you as dividends. But more often than not, we have what we call the payout ratio. A fraction of the profits is paid to shareholders. So, for example, we can say a company's payout ratio for dividends is 50%. So 50% means 50% of the profits of the company is paid to you as a shareholder. Understand? So your dividend per share is the total dividends divided by the total number of shares in the company. Okay? Quite clear, right? I hope you all understand this. So investors expect dividends, and especially when the company is not requiring capital anymore to grow, they should pay out all the profits to the shareholder. That's what the shareholder deserves because they own the company. Okay? Now, why do companies pay dividends? Now, I'm going a little bit into fundamentals, so I'm going to go quite fast because I'm only at topic number 1 and it's already 7:50, right? Company pay shareholders. Is it to reward shareholders? Is it because they're too profitable? Is it because they want to avoid taxes? Now, there are many reasons why companies pay dividends, right? But actually, the real reason should be that they are profitable and shareholders own the company. So you should pay dividends to shareholders. They own the company, right? That should be the reason. There should not be any other nefarious reasons for it, okay? Sometimes there are very, very big shareholders in the company. I'm not going to go through this in detail, but there may be very large shareholders in the company and they want to empty out the company, right? They want to take the cash out of the company. And if that's the case, they may pay a lot of dividends, right? Only to realize ultimately that the company may run out of money as well. So there could be cases like that, which is quite nefarious, right? But otherwise, you as a shareholder deserve dividends because you invested in the company and the company makes profits. Okay? Now, so these are just the different types of dividends that you will come across, the regular dividends. That means every year they pay the same amount of money. So for example, a bank like DBS has a regular dividend, and shareholders of DBS may know that I think and don't pin me to this because I cannot remember, but I think the dividends for DBS could be like 50 cents a year, and it's fixed. It doesn't change. So whether, you know, we have recession, COVID, or we have a boom time, there is a regular dividend that you can expect from DBS. So in a way, companies do that because they want to, how would I say, reward shareholders, or rather, you know, shareholders have this comfort to know that if I own a DBS share, every year I still get something. Because as long as, I think most of the time, even if DBS has not had a loss for many, many years anyway, but even if DBS had a loss, they will have enough money to pay the dividends from the reserves. Okay? Then there's special dividends. Now, because DBS does not pay 100% of their profits, right? They may accumulate so much money over time from the profits. Remember what I said about the share capital account and accumulated profits, right? So that account can become bigger and bigger and bigger, right? So then they say, wow, so big, I don't need so much money, right? Why do I keep so much cash? So they would then declare special dividends to pay to you. So their regular dividends may be 50 cents, and then their special dividends that they declare may be $1, for example. Okay? So that's how you should think about it. Special is not regular. Okay? Now there's another unique concept called scrip dividend. Scrip dividend, okay? Which means dividends in the form of shares. Dividends in the form of shares. So for example, the company still declares a dividend, right? But then they tell you, hey, I give you dividend, but if you want to invest back in my company, it's okay as well. You can give it back to me and I give you more shares. So this is called scrip dividend, okay? Right? So now, when do you then exercise and you say, I want to receive cash rather than dividends, a share of the company, scrip? Which one, then how do you decide? Should I continue to just take the dividends or should I receive the scrip? Okay, now I will explain to you, right? Let me skip this and explain to you. Dividend election. So you may have, in a scrip dividend circumstance, you may have to think about how many shares you want to buy from your dividends. Because say, for example, you receive $1,000 in dividends, right? Then the company say, you can completely buy $1,000 worth of shares, right? Or you could decide that I only want to buy $500 worth of shares. So there will be a form that you'll fill in, right? And then you will say, how many shares do you want in scrip? How many shares do you want in dividends, right? You will have to read the instructions carefully and fill it up accordingly. The other election that's common for dividend election is what currency you want to receive, right? Because the currency could be, for example, in the case of some US denominated stocks like REITs, right? It may be, say, US REITs. They may give it to you in US dollars or give it to you in SGD, right? And sometimes they have one or the other, or they even have two tranches, you know, of listing, right? So Singapore and then US tranche as well. So you can decide which one you want. It's up to you. It's very personal, right? It's very personal. Most of the time, if you forget, the form comes and you throw it in the dustbin, it doesn't matter. You will still receive a dividend. The default is always that you will receive your dividend in cash if you don't elect anything. So you don't have to worry when it comes to dividends. Don't worry that the company will cheat you and not pay you a dividend, right? The company will always pay you a dividend if you are a registered shareholder. All right, so you don't really have to elect. But if you do want to elect, please then decide how many shares you want. Now, I'm going to tell you here when you decide to elect shares and when you decide to have cash. Okay. Now, if you love the company and you think, I already have, in terms of personal decision, I don't need money. I don't need money. I'm happy to continue to invest in this company. I don't mind if I put my money back into the company and I trust the company. I think the company will continue to grow. The share price will continue to go up. Then my advice to you is please elect the shares, right? Now, why do you elect the shares instead of buying the shares in the market? Why do you elect the shares instead of buying the shares in the market, right? If the election price, they always have a price there, they would have stated the price. If the price is lower than what's listed in the market, and it's a decent margin from it, it makes total sense for you to buy the shares, right? Because if you buy the shares from the company, right, you get the shares, you can just sell it in the market and make straight away profits. Okay, that is one way. But even if the margin is very, very little, right? But you ask yourself, if you do this and you re-elect to buy more shares in the company, right? You save yourself brokerage fees. Of course, now they save a lot of money, but you know, for most of the time, I would elect the shares if I like the company and there is some discount. Then I will automatically elect shares. Okay, so that is quite clear. So this first corporate action is dividend. So dividend is quite clear, quite easy. And most of the time, it doesn't need a lot of action on your part. Okay. Okay, now then we go to corporate action number 2. Now, this one is a little bit more complicated because right now, remember what I said, a lot of the corporate action relate to the share capital account, right? But in this case, the share capital account may be affected, but more in terms of the number of shares. The number of shares change, but no money goes in and out of the company. So in this case, you will have things like you probably have heard stock split, all right? That means stock split will mean like if the total number of shares in the company is 100 million, the stock split is 1-for-2, meaning every one share you get if 100 million shares in a company, then you say to yourself, wow, so good, the company give me one extra share. So if my share is 50 cents, right, they give me one extra share, I make 100%, is it? Does it mean that my share become? That is not the case, because remember, the value by total number of shares, 100 million become 200 million. The total per share, per unit, ground zero. You still end up with this. It's just that, so that's a stock split. Now, sometimes instead of saying stock split, and I don't really want to get into technicalities. There's slightly some technicality when whether it is called a stock split or a bonus issue. Okay, people love the sound of bonus issue. Okay, bonus issue. For all wants and purposes, I think people prefer the word bonus issue, and the reason why it is bonus issue is because what happens in the share capital account. If I may go back to this page on the share capital, you can look at the share equity account, right? Can you see the retained earnings there, 197 million or 197 thousand in this case, right? The retained earnings. What happens is that for bonus issue, this number, instead of being in the retained earnings, the company will just make an adjustment and put this retained earnings into capital, share capital account. So into pay-in capital or into common stock account, doesn't matter. So they're just transferring from one account to another. Now the 472,100 doesn't change. Okay, so in the case of a bonus issue, there's no money that has transferred hands. You have not given the company any money at all. Okay, all it did was it just moved the retained earnings into the core capital account. Okay, so all it's telling you, maybe it's a signaling effect to the shareholder, telling you that, wow, I've made so much money over so many years. I haven't given it to you in the form of dividends, right? But I've transferred it to my share capital account to make you feel good. So that's why they call it bonus issue, okay? But actually, there's no money that has changed hands. But it tends to be a feel-good factor because a company is confident. That's why they have bonus issue. Okay, that's what people perceive. But to me, actually, in the fundamental case, whether it's share split, stock split, or bonus issue is the same. Now, then I have here reverse stock split or stock amalgamation. You may have heard of that. Some of you may have heard of that. It's less common, but sometimes the company has come off so much in share price, right? And there are many shares in the market. Then they say, "Wow, you know, my share now 5 cents. 5 cents in the quotation, 5 cents." That is very difficult because I think in some cases you may have a minimum commission per share when you trade, minimum commission. So the commission become very high as a percentage of your bought lot. Okay, like if you buy 1,000 shares for 5 cents, right? 1,000 times 5 cents is how much? 1,000 times 0.05, right? It's $50. It's ridiculous because sometimes your commission you pay $5, right? That's like 10%. So it doesn't make sense. So for them, is the share price becomes so low, they might as well just put, cobble up all the shares and make it less number of shares in the market. So your 100 million share become 50 million share and your 5 cents become 10 cents, right? You didn't make any money. I just told you that the number of shares shrunk and the quotation become 5 cents to 10 cents. But you will find that in your new, when the broker gives you a listing of your number of shares, you will find that the number of shares have gone down by half. Okay, so it's just an opposite of stock split or bonus issue. Okay, all right. So no balance sheet, no changes in the balance sheet, no money has changed hands here. Okay, so that's corporate action number 2. Here again, no action on your part. You don't have to elect anything, but the company may give you a circular to tell you that this has happened. Okay, now sometimes it can be a bit complicated, so please consult your broker, because in the case like for me, I'm a shareholder of BYD and they recently announced a stock split and a bonus issue, so it's a bit confusing, right? So one is they took the capital from the retained earnings, put inside the share capital account, and the other one is they split the total number of shares as well. So there were 2 actions that was happening, but essentially what happened was my 1 share become 3 shares. That's it, simple as that. Don't complicate matters, all right? But at the end of the day, I didn't make 300%, okay? All right. But the advantage of some of this is that sometimes the share price has gone up so much. Like the share price, like some of the Chinese stocks or the US stocks, right? It becomes like $500, $600, whatever. So sometimes they will split, right? So that they make the per unit share price lower. Okay, so that you introduce more shareholders, because sometimes shareholders cannot buy so many shares anyway. Okay, all right. Now, sentiment is usually positive for bonus issue, as I said, feel good effect, introduce more investors in lower share price and improves liquidity. Okay, I think that's quite clear. Now, we go on to corporate action number 3, where money has changed hands. Money has changed hands, right? The corporate uses its balance sheet or internal cash to buy shares back from the stock market. Okay, you may have heard of it in some Singapore shares. I think I cannot recall the latest, and maybe some of you can put it on the chat line, which was the, in the last 6 months or 12 months, which company did share buybacks. Okay, so this one actually has cash that has changed hands. The company has used money from its bank account, right? It has cash, it's got retained earnings, right? It's used money from there to take out cash from the company, go to the stock market, like me and you buying shares in the stock market. You do exactly the same thing, go in and buy the stocks from the stock market, right? So what happens? Has the total number of shares in the stock market increased or decreased? Actually, in effect, they are just like me and you. the total number of shares that are listed has not changed when they do share buyback. Remember this, when they do a share buyback, the total number of shares in the stock market has not changed. They're just like me and you buying shares in the market. Okay, now what has changed? What has changed? If they say we are going to do a share buyback and we cancel the shares, that is when the total number of shares change, right? We do a share buyback and we cancel the shares that we bought back. So for example, a simple case would be, I have 100 million shares in total in the company. I bought 10 million shares, the corporate, sorry, not me, the corporate bought 10 million shares, right? And then they say, I will cancel the shares that I bought. So the total number of shares in the company is no more 100 million, it is 90 million. Okay, now this is good, share buyback is good because the 90 million now, say you make a profit of 100 million. In the past, your earnings per share is $1. Your earnings per share is $1 because it's 100 million profit divided by 100 million shares, right? Now, I have 100 million profit. I divide by 90 million shares because remember the company said, I cancel the shares. Okay? Your earnings per share become $1.11. So your earnings per share immediately uplift by 11 cents. So from $1 become $1.11. Now, you still own the company, right? But you actually benefited even though the company did the action. So share buybacks are good, especially when the company feels that the shares are very undervalued, that the market is not giving them the full benefit or full valuation of the company. So they will use cash from the business, from the company to buy back the shares, right? So the share capital account goes up as well, but the number of shares go down. All right. So usually I like to see companies do share buyback when the share price is very low and not representative of the fundamentals of the company. Okay, it's too cheap. So when the company goes and do share buyback, it gives you confidence as well, right? As a shareholder, because it really makes sense, right? The company knows their business the best. They have excess cash. Why not use it to support the share price in the market, but at the same time benefit all the shareholders for a long time? Because your number of shares immediately go down when they cancel it, right? The number of shares immediately go down when they cancel it, and the EPS goes up. So even if year one, the EPS is 111, year two, 2 years later, the profit grows by 10%, right? The base is 111 per share times 10%. It keeps going. The base has gone up by 1 notch. Okay, so that's very good. Okay, now did money change hands? Money change hands in the sense that the company took the cash out to buy the shares, right? The company took the cash out. You and me as shareholders, we didn't do anything, but we actually benefited. So corporate action number 3, share buyback, benefits shareholders. Okay, I hope that's clear. Now, I don't go through this because I already mentioned it. So why does a company buy back shares? It's a signal on the confidence of the business. As I said, it does not, the share price may not reflect the true value, so the company buys back shares. And then if the shares are cancelled, there's an uplift of EPS. If the shares are not cancelled, maybe, you know, they just put it into what they call treasury shares in the share capital account. They can sell it at a profit and then we all benefit. But most of the time, companies do cancel their shares, right? Now, I'm going to use a little bit of a technical term here called capital allocation, right? The company has excess cash. It can use the cash to buy another business, to invest in new businesses, or it can even invest in its own shares. So we call this a capital allocation decision, right? It has money and then it has to decide now which one should I go for, which investment should I go for to make my shareholders and the company the best returns. right? Which investment should I go for and my shareholders to make the best returns? Just switch on the light. Okay, so often, like in the case of a REIT, right, for example, I would like to see that happen, but very often the REITs don't do that, or even a property developer, when the price to book is very, very low, right? Say 0.2, 0.3 times or whatever, and then there's excess cash in the company, excess cash in the company. Should they go out and buy a building at one time book, right? Should they go out and buy the building at one time book, a new building, or they just buy their shares at 0.3 times book? Which one is cheaper, you tell me? Obviously, the shares are cheaper, right? Not the building, right? You manage to get it at, I don't know, 50, 60% discount, maybe before that, right? Why would you go and buy a new building at one time book when your shares is at 0.3 times book? Doesn't make sense, right? So think about it. If companies have no agency cost, they think for shareholders only, they would do a share buyback when the shares are undervalued. Okay? All right. Now, we go on to corporate action number 4. Corporate action number 4 relates to rights issue or new share issuance. All right. I will do new share issuance first before I explain rights issue. Okay. Sometimes, as I said, the company is growing very fast, or they ran out of money. They have no more money, and they already have borrowed a lot of money from the bank. I don't think it's wise for them to borrow more money. So they may go to shareholders and say, can I get more money from you? Can I get more money from you, right? Now, it's a tricky thing sometimes, because sometimes companies may not, I'm going to be quite blunt, you may not be that nice to shareholders, because what they're going to do is, say the share price is $1. Then they say, I issue new shares at 15% discount, right? I say that, sometimes they do what they call share placement, right? They only issue to the existing shareholders, not to new shareholders. So if I'm a shareholder, they will issue to me, right? At 15% discount, right? Or sometimes they will do new issuance at a discount. Now, if you go at a discount, but the fundamentals of the business is still good, it's not so bad, the share price will automatically go up over time, right? But if not, and people see it as negative because the company has run out of money, they're going to go into bad investments and so on, issuing it at a big discount will annoy shareholders, because immediately the next day the share price will drop. Okay? Immediately the next day the share price will drop, and it's a bit annoying as well. It's like, kind of, as a shareholder, you won't feel very good about it. Okay? So new share issuance, if they're issued at a very, very big discount, often it is because it's almost like saying subscribe or else, right? Because if you don't subscribe, some people use this term, oh, I will be diluted away. I will be diluted away. Why? 100 million shares, for example, in a company, then say they issue 10 million shares, right? So the number of shares that come in is 110 million, okay? And also at a discount. Now, originally, you own, your EPS is $1 per share, right? 100 million profit divided by 100 million shares, your EPS is $1. Now, if they issue new shares, your EPS become what? Divide by 110 million, 90 cents. So it has dropped, right? So you become diluted, right? There are new shareholders now, and then you become diluted. You have 90 cents only left, okay? So what should I do? If I don't mind the fundamentals, I want to support the shares because I think I trust the business, I trust the company, maybe they just went through a bad patch, I would subscribe for my equitable portion, right? So I will subscribe so that in the end, I still own my EPS. I won't be diluted away. If I had owned, 1% of the company, right, and I subscribe to the equitable portion, I will still own the same portion of the business. I hope I'm clear. But so often when it comes to share issuances, if you have the opportunity to subscribe, it is at a reasonable discount, you still like the business, and you think that the company is raising money for a good purpose, right? Like to invest in a new business that is going to grow very fast, the company is still growing very fast, etc., etc. At the end of the day, you always buy shares in the company because you believe in the fundamentals of the company. Then you will buy shares in the company. Okay, so share issuance is almost like new shares that are coming out. You're buying shares, but instead of buying from the market, you're buying from the company. Okay, then the money actually flows into the company, into the share capital account. Right. Now, here I mentioned rights issue. Rights issue. Right. Now, rights issue is the same. It is also new share issuance. But they use the term rights issue because the right to subscribe for the new shares is only for existing shareholders, but not public shareholders. For existing shareholders, but not public. So I have the right. You don't have the right because you're not a shareholder. I have the right. Okay, so that's called a rights issue, right? But for these two, money has changed hands. Money has come from shareholders and has gone into the company. Okay. All right. Effect of the share price after a placement or a rights issue. Now, it's a case-by-case basis. Is the company abusing its treatment of shareholders? Is the discount very large? How many shares have been issued and what is the discount? Was it underwritten? Now, this word underwritten, sometimes you can see in the circular, underwritten by DBS. What does it mean, underwritten? It means that if no one wants to take up the placement, not enough people want to buy the shares, it is underwritten by the banker or underwritten by a big sponsor. They say, okay, I take all. So you know it will not be a failed issue. They say that I will guarantee that it is done. Okay, that's called underwritten. Then you also have to ask yourself, why are they raising money? Is it for growth? Is it to fix a balance sheet? Etc., etc. So at the end of the day, you still first have to ask yourself, outside of all these, whether rights issue, placement, whatever, ask yourself, is this fundamentally a sound business? Are they raising money for a good purpose? Right? If you believe and you think that fundamentally it's a good business, they're raising money for a good purpose to grow, to fix a tight balance sheet, I'll say, okay, go for it. Okay, so the fundamental purpose has to be there. The right fundamental reason have to be there. If you hate the company, then don't bother. Just walk away from it. All right. You have to be disciplined and just walk away from it, right? Or cut your losses, right? Okay. Okay. So this one is a bit more technical. I would say that if you want, you can snap this picture and think about it, but I'll just explain it very quickly, right? We call it the theoretical X rights price, TERP. Now, the company, when they announce a rights issue, okay, will have a cum rights price. And then after that, if you are not a shareholder of the company, when it goes X, on that date itself, when it goes X, even if you buy the stock, you will not get the entitlement of the rights issue. Okay, so in this formula, you will notice that usually the rights may be separately listed. I think in SGX it's often separately listed, right? There is a theoretical X rights price, right? It's a theoretical price. Now, this price is calculated essentially by, if you think about it, money has changed hands, right? Money come from the shareholder, gone to the company. So the company has more money now, correct? But the number of shares has also increased, right? The number of shares from 100 million, say the rights issue is to subscribe for 10 million shares. 100 million become 110 million, okay? So that's why the formula, you can see on the denominator, N, which is the existing number of shares plus the new share issue. Okay, that is the new number of shares. Now, then the theoretical X price is money that goes in. So rights issue price multiplied by new shares issued. That's the money that has come into the company. And then this one, N times current market price. That's the existing value of the company before the rights issue. Okay, so essentially the concept is all the money that has come in, the existing business value plus all money that has come in divided by the enlarged share cap, enlarged number of shares. Divide by the enlarged number of shares. Okay, now rights can sometimes be sold as there is a separate listing, and the theoretical price is equals to the current market price of the shares minus the third price. Okay, the theoretical X rights price. Okay, so there is a rights value to it, and then you can also sell it off, right? Rights issue price is the price at which the new shares are offered. And because these new shares are offered at a discount, right, the differential, there is a value to it. Okay, so then you can calculate what is the X rights price. So the market price minus the X rights price is the value of the right. Okay, this is a bit more theoretical. And if most of you want to subscribe for the shares, this doesn't really matter. Don't even bother about calculating X rights price and so on. Okay, you just look at the circular and put your money in. That's it. No need all this nonsense, right? But unless you say, okay, I don't want to subscribe, then you can see that there's a value to the rights. You can sell the rights in the market. Then you can calculate this theoretical X rights price. Then you can see, is there a differential? If there is, there's a profit to be made. You can sell it. Okay? All right. So what do we do when there is a corporate action? So this is more pragmatic, practical steps to take when there is a corporate action. What do we do? Remember to check broker communications, right? You do not want to miss elections that will put you in a disadvantaged situation. So for example, if there is a rights issue and then you forget to subscribe and you forget to sell your rights, you probably have lost some money because you could have sold even if you didn't want to subscribe, you could have sold the rights in the market. So you actually lost money from it. Okay. Or for example, if there's a share placement at a discount, you might want to buy it instead of buying it from the market, right? So things like that, you need to constantly make sure you stay on top of the news flow of the companies that you own, right? So my advice to you is, nowadays we don't have brokers, right? We only use these platforms, right? If you have a broker, great, let your broker know what shares you own so that he can alert you. But if not, there is an XGX announcement page, and you can put your own watch list there to make sure that you keep on top of corporate announcements, right? Some require action and some do not require action. Okay. Now, it's very important. What I always do when I receive corporate actions is that I look at the filings, because often they are sent to me or there's an electronic copy. I will highlight all the deadlines because the deadlines are important. Sometimes we are busy and we miss the deadlines. So better highlight to make sure that you submit everything on time, right? Don't leave your letters unopened, which is quite typical for a lot of people. And then you find that you miss the deadlines, right? So make sure you know the deadlines. Also understand the cum and the ex dates, right? Now, these are important dates. There will be a period when there is an entitlement. So it's called cum, right? You will see it often, right? Cum rights, cum bonus, cum rights, even cum bonus, I think, and then cum dividends, right? So why is there this word cum, right? Actually, I don't know what the full name is. All I know is cum. I think it's maybe cumulate. I'm not sure why they use the word cum. You all can Google it. But it means that when you buy the share, you have the entitlement. So it's called cum. All right. Now, remember, there is a, how would I say? There is a turnover time for registration of yourself as a shareholder of a company. In the case of Singapore, it is 2 days. So the day we buy the share, you only become a shareholder at T, which is transaction day, +2. Right? I think it's 2 days, if I'm not mistaken. Yeah. So there is a time lapse. You don't buy today and automatically you're a shareholder. It takes 2 days. remember what I said, that all these corporate actions relate to actions between you and between the shareholder and the company. So you must be registered as a shareholder to, be involved in all these corporate actions, right? So the cum date is really to make sure that you know, right, that if you buy, this is your entitlement. Then there will be a date which is a cut, or there must be a cut-off date. So that date that is cut off is called X date. So the X date is the one where if I buy, I don't get any entitlement. So sometimes you can see, right, cum div, X div. Cum div, so let's say the dividend declared is 50 cents, for example. Closer to the cum div date, you see that the share price starts to move up towards the dividend amount. Say in DBS case, 50 cents, say, for example, right? On the X date, right, is the date where if you buy, there's no more dividends for you. It's given to the shareholder that sold it to you, okay? The share price will drop by 50 cents. That's how it works, okay? All right. So this one, I'm not going to, I already explained to you. I'm not going to explain in detail cum div, ex div, right? But essentially, these are dates where you get the entitlement and no entitlement. So please be aware of these dates. Now, the last action that I want to talk about is M&A and spin-offs. Now, this is a little bit more difficult to understand, and it involves the change in the complexion of the company entirely. Right? It's not just about getting new money into the company or giving money back to shareholders, right? This may involve a significant transaction to the business, right? It involves a significant transaction to the business such that the shareholder has the right to elect whether this transaction should be approved or not. In the case of SGX, I do believe that a significant transaction is something, and if anyone knows, please tell me, but I think it's something that is above 10% of the company. Anything that has a significant transaction that is worth more than 10% of the company may have to go for a shareholder vote. Okay, because shareholders have the right to decide whether the complexion of the company, the ethos of the company, the spirit of the company has changed. Now, the other thing also could be that someone wants to buy over the entire company as well. So this is called, a merger. Or the other way is that the company says that, I have 5 different businesses. I want to sell what we call 2 non-core businesses, spin it off. I'm not interested in that business anymore, or I think I can sell that business at a much higher value to benefit all shareholders. I would do that. Okay, but often because these are significant transactions, right? These are significant transactions, it will require a shareholder vote. So this generally comes out in the case of an extraordinary general meeting, EGM, where you will have to vote. So if you're a shareholder and an interested shareholder, and please vote, right? If you support the deal, please vote. If you do not support the deal, also please vote not to support the deal, because I think your share vote counts as an independent shareholder. Often, in these cases of M&A or spin-offs, the major shareholders that are involved in the deal, like the insiders, the management, or the sponsor, anyone that is a very, very big shareholder inside, may not be able to vote. May not be able to vote. Only the independent shareholders like you and me will vote. So they need to have a majority voting of the independent shareholders. Now, when these significant transactions happen, it is often that they will get a financial advisor, supposedly independent, to weigh on this transaction and whether it is beneficial to shareholders. Because sometimes we may not be professionals and we don't understand, right? And you would prefer an independent consultant to weigh in on the deal and advise you whether the deal is worth it. So in the case of a merger and acquisition, for example, which is quite common, right? Say the company is worth 100 million. We go back to the same number, 100 million, right? It is undervalued. Maybe the true value of the company, the book value of the company is 500 million, right? 500 million. And, professionals may come along and say, hey, this company is worth a lot of money. They even have 70 million cash and the valuation of the market cap is only 100 million. I'm going to take over the company. So I offer to you say the share price is $1. I offer to you 150. So I take over the company. Say the valuation of the company is 100 million, as I said, right? 100 million listed, book value 500 million. I say I buy over for 150 million. Good deal, right? For me as a big takeover person, I go and buy the share for 150 million. The true value 500, no? I buy for 150. Pretty good deal, right? Now, will shareholders vote for it or not? Well, it depends on the shareholders, right? Some shareholders, if they manage to influence, they may vote for it. But if you're a smart shareholder, maybe you'll say, hey, the value is 500. Why should I give it away for 150? Right? Maybe I wait for a competing bid. Maybe sometimes the company will say, okay, since this person wants to take over my company, management sometimes will say, I don't recommend. I do not want to sell the company, right? I do not want to sell. So management may write a note to all the shareholders to say, no, we don't think we should sell the company, right? Or the other version would be that maybe the advisor also will say, no, don't sell the company. So the company may come back with a higher bid, or it may walk away, it depends. So that as a shareholder, that's the chance that you have to take if you say no, right? If you say yes, automatically you make 50%, right? But if you say no and you walk away and no one else bids, too bad. But there is a true value of the company. You hope some other person or over time, the value of the company will be realized. Okay, so it's a bit more complicated in M&As. You really need to understand the fundamentals and the, the complexion of the M&A. So do read the broker reports, do read the circulars that come, do read the independent advisors reports if you can. Okay. Sometimes there's this thing called unconditional and conditional, right? Unconditional means no questions asked, I will just do it. Conditional, maybe like they will give some condition like, oh, if we can do due diligence, we find nothing wrong, so on and so forth, right? There's all these things. It could be partial takeover, it could be full takeover. That means takeover entirely, or partial takeover could be that I buy only 50% of the company or something. Okay? So that one requires you to vote. So there must be action on your part. Sometimes we cannot be bothered. If our shareholding is so small, we cannot be bothered, right? But often if you feel strongly about it, put in an effort to vote because your vote counts, okay? Okay, spin-offs. I won't go through this. It doesn't happen so often. I think recently there's one case, one of the companies in Singapore is doing some spin-off. So why do they do spin-off? Sell down, better valuation, non-core, better as a separate entity. I mean, there are many, many reasons, and they're going to cite all these reasons. What's in it for the shareholder? At the end of the day, you need to look at your valuation. Does it make sense? What are you going to get in return? Are you going to get the shares of another company, or are you going to get cash? I think cash is always better than shares of another company because you really don't know how the listed company is going to perform after that, right? The spin-off company is going to perform. So cash is always better. It's more certain. And then you also have to ask yourself, if they're going to spin off all the gems, all the good businesses, you're left with an empty shell. That's a bad deal, right? You end up holding something that is nothing at all. That's a bad deal, right? So you have to think about these things and vote accordingly. Okay, so I've gone through 5 corporate actions. Let me just summarize before we go to the synopsis. So okay, so what have we covered, right? We have covered dividends. We have covered bonus issues or stock splits, right? We have covered share buybacks and rights issues, and then we have covered corporate actions in terms of M&As and spin-offs. So that's quite comprehensive. There's already, most of the corporate action. If you look at the list in SGX, this is most of the things that has happened, okay? But at the end of the day, I just want you to remember one thing, okay? And the questions that you want to ask yourself, right? Question you want to ask yourself is, you as a shareholder of the company, do you believe in the fundamentals of the company, right? That's one thing. Whether there's corporate action or not is immaterial. You need to understand that you as a shareholder, you believe in the fundamentals of the company. And then secondly, when it comes to the corporate action, the before and after effects. What is the before and after? Is it better? or worse, or no change. Okay, so you have to ask yourself that. So I stop here. The time now is 8:33. We have the webinar till 9 o'clock. So I'm going to do a worked example of Fraser's property rights issue, just to run through with you. But before we get there, maybe I'll just, just to break the rhythm a bit. And, it's quite weighty. There's a lot to cover. There's a lot of information. Maybe I will take like maybe 10 minutes of questions first on the topics that I've covered, and then we will go through the case study. Okay. Okay, I see here in the chat. So please put your questions on the chat. I think it's easier for me. Here there's in the chat, dividend increase valuation as calculated, but pay dividends to increase. Okay, I'm just going to go through 3 banks bought back shares or high price some more. Yeah, for companies condition rate, is there a limit to the number of shares they can buy per trading day? Okay. All right. There are some questions relating to share buyback and whether there is a limit to the number of shares that they can buy per day. Okay, there's no limit to the number of shares that they can buy a day. But if it's a sensible company, right, you don't want to buy so much that you push the share price up, right? I would say, not very wise, because at the end of the day, you want to, same as any other shareholder, you want to buy low, sell high, right? Or you want to buy low, full stop. Okay, so don't be silly. Most companies will not do it. They will not put in so much that it will influence the share price, and then after that, after the share buyback, the share price crashes meaningfully. But yes, sometimes there will be some action. I mean, the share price may be supported momentarily. So you do see at the end of the day, the company will report they did a share buyback of how many shares. Now, when there is a share buyback, there is always what we call the share buyback program that I have not mentioned in my. Read the announcements of companies. They will always show you that they have an intention to buy back a certain number of shares over a certain period of time. So often they will announce the quantum of the share buyback, the number of shares or the value. So they'll say, I will buy 20 million worth of shares. Okay, 20 million in value worth of shares. Or I will buy, they don't usually say number of shares because the number, the value changes all the time. Usually they will target the quantum, right? Like, for example, in the case of DBS, someone mentioned that OCBC, DBS, and UOB have done share buybacks. Thank you very much. So what they have done is they will say, okay, over the next 12 months, I will buy back, 500 million worth of shares, right? So, but they don't tell you, like, tomorrow I'm going to do a share buyback, and they don't tell you. They will do it first, and then they will announce it. Okay? Because obviously they have to move in stealth. They cannot tell you first, because then you'll be buying ahead of them and front running them. So no. Okay? So, but there is a limit to the share buyback. According to regulation, I think the limit is 10% of the total number of shares, right? The share capital. So they cannot buy back, many, many times the worth of the company, right? Doesn't make sense, right? So they will buy back only up to 10% of the number of shares. I think that's the cap. Okay. Do you have any questions? Okay, let me see. I'll just run through here. Dividends. Is there any rule on how soon must the dividend be paid to shareholders from the date? Oh, okay, there's no rule. There's no rule to declare cum and ex. Sometimes you can see that the difference can be in terms of like 5 months, 4 months. It's quite long sometimes, right? I don't think there is a standard rule they often declare their dividends after the year-end announcement, okay, or after the interim results, right? Then they'll say, okay, based on the results, based on the profits that I made, this is the amount of shares that, this is the amount of dividends I'm going to pay you, okay? So the share price has not gone cum yet, right? It will go cum when they declare. So they will go through, a general meeting, because every year, remember, they will have a, not extraordinary, they will have an AGM. an annual general meeting, right? Then you have to vote in the auditor, then you have to approve the dividend, etc., etc. So the shareholders, all this is very procedural. It will always go through, right? So once that is voted in, then they will pick a date to declare the dividends, right? Then in the run up, so there will be a dividend declaration date. I really don't know the time from the declaration to the time it becomes cum. I think it's a matter of, I don't know, weeks, I think. I'm not very sure, but these dates are very, very transparent and shown to you. Go to the announcements and read it. Okay, they're very, very transparent. But like I said, from the time they declare it to, sorry, from the time they say they're going to pay you dividend to the time they declare it to the time it's paid can be as long as 6 months. So that's why there is a lag, you know. They can say, okay, I declare dividend at the end of the year, I declare dividend. By the time you get the money inside your pocket, it can be June already. Okay, it's kind of like 6 months lag. All right. Okay, the other thing. Sometimes REITs would do reduction of nominal value. What is the reason for the REIT to do this? What is the difference between reduction of nominal versus giving dividends? Okay, I actually am not very clear of what it means by reduction of nominal value, but I think it's meant to be the reduction of the, if anyone can explain. Okay, to be honest, I have to come back to you on that. And if you can cite me the company, what the meaning of nominal value is, because that's not a common term that is used. Maybe what they mean is the reduction of the number of shares, right? Not the reduction of the value of the shares. It's probably the reduction in the number of shares. So that's equivalent to a share amalgamation, right? Like the shares may be 10 cents. They just want to merge 2 shares to become 1. So it becomes 20-cent share, right? Okay, so there's no impact to dividends. I mean, there's no impact to the value of the company, as I explained. If you can, I will give you my contact and you can email, you can LinkedIn me to ask me further if you give me the company name. Okay. All right. Someone asked me here, SGX forbids listed companies from distributing the assets as dividends. Okay. Dividends should be restricted to cash or company shares. For example, Keppel and Oxley distributed their shares of listed subsidiaries. This caused unnecessary to shareholders with odd lot shares in companies which have no intention to invest. Okay. Okay. Dividends, by definition and by regulation, has to be distributed out of retained earnings, right? Dividends is always out of the profits of the company, right? Again, let me say it again. Dividends is out the profits of the company. So only when the company has profits do they declare dividends. They cannot declare dividends if they make losses. That's it. Okay, simple as that. Now, if the company, right, wants to spin off another company, that's separate. That's not a dividend, right? That's a spin off. Here you're asking me, you're saying that this company has listed distributed the shares in listed subsidiaries. Okay, so that's a spin-off. That's not a dividend. Okay, that's a spin-off. That's not dividend. Now, if they give you the election spin-off, I sell to somebody else, you get back cash, that's great. But if you get back shares, sometimes it's a bit of a pain in the ass, you're right. It can be very illiquid, you know, it's barely traded, nobody's interested in it. I wouldn't approve it and I wouldn't even vote for it because, like you said, it is very inconvenient. It's not practical. Okay. But like I said, dividends is only paid out profits. Okay. Okay. How can minority shareholders make our voices heard if we receive a low ball management buyout from our stock? You can definitely make your voices heard by voting, because often when it comes to important corporate actions, the shareholders, the management, they call them shareholders in concert, in concert. The shareholders that are involved in the deal, which are management and maybe the buyout company, are not allowed to vote. Only independent shareholders are allowed to vote. So your voice, even if you own, you know, the public shareholders own 20%, 30% of the company, right? and the 70% is owned by important large shareholders and the founders of the company, only the 30% are allowed to vote. The 70% have to step aside and not vote. And in that 30% that have to vote, often it has to be majority. That means more than 50% of the 30%. That means 15% and above have to vote yes. And not only that, the total number of shareholders that are present in the meeting has to fulfill a minimum number, and also raised hands must be more than, I think raised hands must be more than 50% or 70%. I cannot remember. There are certain rules to it. So it is quite stringent for some of these major decisions. What I'm annoyed with is sometimes, you know, what they do is they, I hate to say it, but they may contract an independent financial advisor. And this financial advisor will go along with a fairly low ball valuation, because what they will do sometimes is they will say, oh, it is above the last 20 days trading price. I mean, that's ridiculous, right? The share price has been listed for like 50 years or whatever, and then you only look at last 20 days. It doesn't make sense, right? And there are many, many reasons why a share can be low in price, right? It's illiquid, you know, maybe the company has a lot of assets, but it hasn't been paying dividends. It hasn't been, you know, it hasn't been totally shareholder friendly. Let's put it this way. That's why people just give up, right? So often, you know, if the buyout is low ball, you should ask for, you know, if you are smart enough, you can write a letter lah. But if you don't want to be an activist, there are activist shareholders that would write letters to the management and represent shareholders, or you can go to the meeting and object to it, right? But often, let's not be, I will say, take a pragmatic view. Take a pragmatic view. If it's low ball and you really think that you are pushed to a corner and there's no competing bids, sometimes you may not have a choice. Okay. Okay. What the implication of Centuria upcoming IPO, Centuria share price and performance? Okay. So, yeah, that's what the one that I was talking about. I think they're having a spin-off, correct, of the REIT. This is all back to fundamental valuations, and I'm not going to weigh in on that because that's a separate discussion altogether on fundamentals. Okay. But at the end of the day, like I said, what you want to ask yourself is the pre and the post action. The pre before the IPO and after the IPO, what is the implication to the valuation? So you really need to do the fundamental valuation of the business. Okay. All right, let's go to the case study now. We will thank you, Clee, for the cum means with. All right, thanks. All right, we will go through this case study very quickly because it is already 8:50. I will exceed the time if you all don't mind for a while. All right, so this case was in March 2021. Okay, so this is a rights issue of Fraser Property. So this is actually a real case, right? So Fraser Property had a non-underwritten rights issue. Okay, what does it mean, non-underwritten rights issue? It means that they want 1 million rights, right? One here we have 1 billion actually, yeah, 1 billion rights. Let's say not many people take it up and it's undersubscribed. Too bad. They will just take whatever that people give them. So it's undersubscribed. Okay. At an issue price of 118 for each right share on the basis of 37 rights for every 100 existing shares. So how do you know how many rights you get? Right? If you own 1,000 shares, right, you divide 1,000 by 100, then you multiply by 37. That's your number of rights, right? So you just divide out by the ratios to get your numbers, okay? So your rights issue, you have the right, so now remember, rights issue, what it is, the money still change hand from the shareholder. Me as a shareholder, I'm entitled to the rights, must pay $1.18 to Fraser Property because Fraser Property wants to raise money. Okay, wants to get money wants to get money into the company. In this case, it's not doing a placement, it is doing a rights issue, meaning that it's only placing it out to existing shareholders. in the ratio of every 100 shares, you get 37. Okay? Right. Now, let's look at the timing here, right, which is quite important. It says here, last date and time of splitting and trading of the rights is 19th of March. So that means it goes that the rights are listed now. It's going to be listed and it will trade until 19th of March. So if you do want to subscribe, you can sell it in the market. There will be a rights price to it. Now, why is there a rights price? It's because, remember when I said you calculate the theoretical X rights price, that is the share price minus the theoretical X rights price. That is the rights price. Okay, so there is a value to it. You can trade it in the market, right? Last date and time for acceptance. Okay, so what happens? Last date and time for acceptance and payment of the rights is 25th of March at 5 p.m. So make sure you make it on time, right? You can do electronic payment. So remember these dates, okay? So these are the timelines. As I said to you, you use a marker, highlight all these dates, okay, because they are very important. Make sure they lodge the offer on March the 8th, right? March the 8th. Then they dispatch to you. You should have received it by 11th of March. Then the trading of the rights is 11th of March. Okay, usually it's a discount between the mother share and the subscription price. Then the first day and time for acceptance. So instead of trading the rights, because if you want to subscribe, you don't need to sell the rights, right? You can just put your money through the ATM and subscribe for the rights. Okay. Now, at the end of the day, so you just have to know, expected date of issuance of right shares is 5th of April. So from the time 8th of March to 5th of April is almost a month, right? So you put in your money on the 25th of March. You only get your shares on the 5th of April. Okay, so there is a time lapse. There's a time lapse in between. So you just have to take note of that as well. So don't go and sell your shares when you don't have the shares yet. Make sure that you receive the shares first before you sell it. Okay, right. So issue price 118 for each right shares. Discount. So this is where it's important, right? What is the discount? It says here 4.8% of the last traded price, 3.6% to the third price. So this is the theoretical extra price. Remember, they actually calculated it for you already. So it's 3.6% discount. So it is likely that the rights that will be traded in between those two dates there will be probably somewhere around this 3 to 3.6% of this price. So I don't know, 1.226 times 0.0033 6, right? Something like, maybe 0.4 cents or something like that. Quite little per share. But there's still value. So if you don't want to subscribe, you better sell it off in the market. Okay. Then down here, because Fraser Property was traded way below book. It says here 47.5% of adjusted NAV. So it's quite cheap now, the share price. So they raised money. The shares are way below book, right? They needed to raise money. I don't know for whatever reason, but it is at a discount to the NAV of the shares. Okay, so when I look at it superficially, these are the questions that I want to ask yourself. What is the purpose of them raising that money? You want to ask, how much is being raised? Is the discount sufficient? Is the rights backed by shareholders, or is it underwritten? So anyway, the prospectus is in this link page. You can go and look at it. But these are the simple questions that you want to ask. So ultimately, do you really want to give more money to this company? Are they doing a good job anyway? Right? If you don't want to give the money to the company, just sell it off. Right? If you want to give more money because you think this is a good time during now remember the date here, I think it's right in the midst of COVID as well. Was it? Yeah, during the COVID period, right? Yeah, in COVID period, right? Almost close to COVID period. Maybe the share price was bashed down quite a lot. So you think, oh, well, not bad. I'm getting a discount. I might as well just subscribe and then wait for post-COVID to sell the shares, right? So that's the decision that you want to take, because fundamentally you believe in the business. You think that this business over the long term, it has done okay, you would subscribe for it. All right. So that is it. All right. This one I won't cover. This is just EGM, AGM, which is happening every year. Okay. So we are done with the webinar proper. Let's just do the Pigeonhole Q&A. Passcode is 17th of July 25. Please do this. You can do a QR code on this and write your questions there, and then it will be flashed, and then I will answer accordingly. But meanwhile, I'll just look at some of the questions that I did not address in the chat. Okay, and then you can post your questions into the chat line, into the Pigeonhole. Sorry. All right. I just want to comment on something on paying dividends and whether that raises the valuation of the company. Now, okay, well, I don't want to go through not theoretical or whatever, but at the end of the day, in a perfect world, you own the business. You as a shareholder own your share of the business, and you are entitled as much to all the losses as the profits of the company, because you own a share of the company, right? The management of the company is there to make sure that the company runs well and rewards you as a shareholder or pays you as a shareholder. What they pay you as a shareholder annually would be the dividends. Okay. Now, some companies are very kiam siap. They don't want to pay because they want to keep for themselves, and they say that, oh, just in case I need for new businesses, blah, 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 right? If a company is growing very fast, it makes sense for them to not pay dividends and keep the money to invest, right? If they're doing a good job to grow the business, by all means, don't pay me dividends, because my dividend, once you pay to me, it's gone, right? Take that money and invest, and then have a long stream of profits in the future. In a growth company, that makes total sense, right? But in a mature company where there's very little, where there is very little growth opportunity, it makes total sense for them to pay you dividends, right? It makes total sense for you to not only pay dividends, but it may even pay you special dividends. So actually now on the top of my head, I can remember one case, which is Singtel. Is it a fast growth company? From the last I looked, no lah. It's not growing at 20%, 30% a year, right? It's Singapore, is mature, the region also, mobile telephony and so on, it's quite mature. So they're probably growing at single digits, maybe 4 to 6% a year, not very fast, okay? But their business is very cash generative. Every year they have a decent level of profits, and every year the profits, they don't need to, the operations, the profits they generated from operations don't need to be, they have a certain sum put aside to invest in data centers and new networks and so on, but they're not investing in new companies anymore. So if I recall back, 15 years ago, they started buying things like, AIS, Telkomsel. Did they buy Telkomsel? I know they bought an Indonesian company, I think it's Telkomsel, and then they bought Bharti in India. And then they invested in Thailand and so on. So they had invested in and Philippines, Globe Telecom as well. So and Optus. So they invested in a lot of regional businesses, right? Regional telco companies. And after 10 years, these regional telco companies have become more mature. Like in the case of Bharti, now they are selling down their Bharti shares because the valuation is good. It's been 10 years. It's become more mature. It makes total sense for them to sell it. So this is in the case, it's a non-core, you would say it's a non-core spin-off, right? You would say it's a non-core spin-off, so they're selling. So when they sell the shares, they will get a sum of money back, right? So now when they sell the shares, they get the sum of money back. Then they say, hey, I'll do share buyback lah. Since I have shares in the market, I will go in to buy back shares and cancel my shares. So that's to the benefit of shareholders. So you can see what they have done with their capital, right? They have given you dividends, right? Maybe they have raised the payout ratio as well. I recall during COVID, they did cut their dividends anyway. So now they've raised it back. But at the same time, with the shares, with the cash that they have earned from selling Bharti shares, they're going to do a share buyback. They did announce a share buyback program of, I think, $5 billion, if I'm not mistaken. Okay, so if you were to be, or you are a shareholder of Singtel, you are going to enjoy a higher EPS because of their share buyback, and also you're going to have a decent, higher, I think a decent dividend stream as well. Okay, probably some, I can't remember whether they're going to give specials. Yeah. Okay, so let me look at the Pigeonhole, whether there are any questions or not. Okay, can you please refer to questions in a Pigeonhole? Okay, let me get the Pigeonhole. Where do I go to the Pigeonhole? Let me see. Okay. How do I get to the Pigeonhole? Let me see. All right, I think I am just going to go to the Pigeonhole myself. Hold on, All right, I'm just going to address the questions as well in the chat line. Okay. There's one that said Capital Investment had actually paid Capital CICT as scrip dividend recently, Capital as scrip dividend before too. CDL also paid CDL Trust as dividends too in doing to boost the dividend yield. Okay, thank you for that. Okay, I click the Pigeonhole here. Done. Okay, I cannot click through. This okay. I'm going to just put it here in the Pigeonhole. Sorry, I just go into the Pigeonhole now. If you can, the host, can you open the Pigeonhole for me? Because I can't click through it. All right. Anyway, I can see it on my handphone. I'll just go through it. Okay. RIF is advising minority shareholders in a takeover really independent as they are paid by the company to write the report. Officially, yes, they are independent. That's why they're called independent financial advisors. But because they are paid by the company, I don't know, are they independent or not? So I think what you really have to do objectively is to read their report to see whether it makes sense. Okay, because sometimes they may offer you, they may weigh in on certain things that you will not know. But I would say that I've come across cases where they really support quite a low ball number. And so shareholders have made noise. And in fact, I think shareholders may have expressed their displeasure during the extraordinary general meetings. Okay, right. So yeah, they're supposed to be independent, but they will always cite their reasons why they support a deal or not support a deal. Okay, they usually support a deal because they're paid by the company, right? So just read it for yourself to see whether it makes sense. How does share buyback affect NAV in the case of when shares are held in treasury are not cancelled versus the case? Okay, this is again what I've explained in the webinar. If you have 100 million shares in the company, and you do a share buyback and you say, I do not cancel the shares, right? I do not cancel the shares. The 100 million shares are still 100 million shares. What happens is that the shares, they didn't disappear. Say the company bought back 10 million shares. It didn't disappear. It went from the cash account of 100 million into the capital account of 100 million in the balance sheet. They took the cash out, bought the shares, and then they put it into the share capital account in the form of treasury shares. Okay, it's an accounting entry, but the effect of it is that the shares are not cancelled. So your EPS or your NAV per share does not change. Because why the shares not cancelled? The shares are not cancelled because the company just bought the shares in the hope that, because they think it's cheap, in the hope that 6 months down the road, 2 years down the road, they can sell the shares at a higher value. Okay, but the number of shares in the company has not changed. Understand? I don't think this is
practiced as much in Singapore. I don't believe it's practiced as much. There are some cases, but most of the time, share buybacks, they usually cancel the shares. Okay. With some brokerages, shares are held in custodian and not CDP. How do shareholders take part? Yes, even if it's in custodian, okay, you may vote, but you're not voting in your own name. You're voting in HSBC nominee, Citibank nominee, whatever, JP Morgan nominee account or something like that. So don't worry, you can still be entitled to vote. It's just that your name is not showing up. So these corporate actions, you will still get the circulars. You will still get the digital, some companies have digitized it, right? Or they send you an email. You'll still get the information, so you don't have to worry about that. Someone asked me, what's the proper thing company should do after divest part of the business? I don't know what this question means. What exactly? If you can expand, it would be great. I don't really understand the question. Okay. In a case study, if less than 100 shares will still get rights. Example 99. Okay, so there in the case study, right, they did say that there is a rounding. They did say here, it says here, fractional entitlements to be disregarded. So like point something share, then forget it. But I think when it comes to one share, you can still get, but you cannot get 0.5 shares. You can only get one share. Right, so 36 shares, you can still get 36 shares. Yeah. So you have to then sell it in the odd lots market, and usually odd lots are at a discount anyway in Singapore. Okay. If we buy shares through a custodian, okay. Yeah, I think that question has already been answered. If we buy shares through a custodian broker like Momo, we're entitled to vote. Our vote will be submitted independently or okay. Yes, your vote will be counted independently as part of the group. So it doesn't mean that if you have 5 shares, you voted yes, and then the other 100 shares that they hold under the Momo custodian voted no, you have to vote no with them. No, everybody is independent, so you don't have to worry. Okay. Now you just have to take note that some of these platforms may not be totally on top of that's my personal experience, that they may not be totally on top of corporate actions. So you please alert them whenever there's corporate actions and you didn't receive any circulars or you didn't receive any notice. So I know it's a bit troublesome. Most of the time in Singapore, they will send the circulars to your house, even if it's held under custodians, right? I think so. Yeah, they will send it to your house. If not, then you need to alert the platform to vote for you accordingly. Okay. If we buy shares, okay. Sometimes REITs will do, okay, this one I really don't know what you mean by nominal value. Reduction in nominal, what's the reason? Okay, I think what you mean here is that, say, the capital account has 100 million, okay, 100 million shares, right? And then they split it to 200 million shares. I think that's what it means. Then nothing has changed, and all they did was just increase the number of shares. That's all. Nothing has happened, right? It's just the number of shares that's changed. If you could cite me the example, this person who's asking this about nominal value, then I can answer you, because I don't really know what that means, nominal value. Okay. Anything else? I think that's about it from all the questions that are asked. Are there any more? Let me see. Okay, I think we are done with the questions and answers. I'll just say this, if I can share my slides back again, and I'll just say that corporate actions need not be something that is too complicated. It need not be complicated. It can be simple. Just make sure you know the dates, and then make sure that you know the before and after case. What is the before case? What is the after case? Okay. And do you still like the company? So you need to first ask the fundamental questions before you vote for yes or no. Ask yourself those fundamental questions. Consult your broker, read the broker reports, and so on. Anyway, I am an independent career coach, independent financial coach. So seek out my services if you're interested. I do one-on-one and I also do group classes. The other thing is I can be contacted on LinkedIn as well. So if you need to ask any further questions on this topic, please link me in. And that's my contact under Pearly Yap. I usually will, I mean, some of you have asked me questions before and I usually answer quite promptly because I'm on LinkedIn almost every day. I do have, comments on career as well as on, investments and general investment. It tends to be a little bit more technical, but if you want to have an ongoing investment education, I do write about my investment ideas, my investment thinking on my LinkedIn page. So do read it. Because I'm quite an active private investor. I invest in Singapore stock market. I invest in Australia and Hong Kong. Less in Singapore because there are so few available, so few companies available. More in Australia, more in Hong Kong and China, because there's a lot that's going on there as well. So there's a lot more to talk about. But happy to engage, and you can find me on LinkedIn. So I really appreciate this session and listening to me. I know it's quite weighty. There's a lot to take in. I hope you have, after this session, you have more insights into corporate actions, and you have a clearer idea. But if you have any questions, like I said, please hook me up or even ask your brokers. Okay? Thank you very much for your time. I do webinars now and again on SGX, so just do look out for it. And at some stage in the future, I may do some independent webinars on my own as well. But I haven't really got round to it yet. But yeah, just hook me up. I'm always happy to engage with shareholders and investors alike. So thank you very much for your time. I really appreciate it. Spending all this time with me tonight. Okay, have a good day. Bye, everybody.